And welcome everybody. I'm really delighted to see so many familiar faces and so many people in the room. And of course I also want to welcome everybody who is watching us on the simulcast. It is really an exciting event today, and I want to say that on top of it we will also be videotaped by a Korean television crew who is making a documentary on T1. So let's get right to it. My name is Antoinette Schoar. I'm a professor here in finance at MIT, and I'm delighted to introduce two very distinguished co-panelists who are also MIT grads. In fact, MIT and Sloan grads, both. So we have Chi-Won Yoon and Dr. Ben Golub. Ben is a managing director and also founding partner of BlackRock. He oversees, as the chief risk officer, oversees BlackRock's risk management, and he's also the co-chair of BlackRock's corporate risk management and new products operating committee. So welcome. And Chi-Won has been the CEO of chairman of UBS Asia Pacific since 2009. He's also the member of the UBS Group Executive Board, and in a prior role he served as the head of UBS's securities business in Asia Pacific. So welcome to both of them.
Thank you.
I want to just make a quick remark that we are all, but in particular my co-panelists, are here in private capacity and not as spokesperson for their respective organizations, so that we can speak a little bit freer. Let's see how free, right? So we have a very exciting session today. We're going to talk about the lessons from the financial crisis, and obviously this is a very important topic that has been in many people's minds and hearts. What we want to focus on is, most importantly, what are the long-run implications of the crisis? How are institutions today dealing with the aftermath of the crisis? And how are regulators, not just the private sector, how have they responded to it? How should they be responding going forward? And it's in particular exciting to me that we have this mix of the view from the US side and from the Asian side, and we will be able to contrast fast emerging financial markets and more developed financial system as the United States. Just to give this discussion a little bit of a background, obviously after the financial crisis of 2008, two things have come into really sharp contrast to this crisis. On the one hand, we've seen how integrated and how global the linkages in financial markets are, and I think even the most veteran observers and participants in financial markets were very surprised to see how quickly the crisis spread and how far it spread across the world and to different markets. And I think the second point that is important to make again is that it really showed how much finance matters, right? There's always a little bit of a debate, does finance really matter, or will finance follow the real economy and just kind of fall into place when the real economy either grows or shrinks. But I think this crisis has taught us very dramatically how causally the financial crisis can affect real outcomes, right? Now, the debate, however, has now shifted to where do we go from here, right? What should the response to the crisis be, and as part of this, what has brought upon us the financial crisis? And before we get into the details, I want to just highlight that the discussion here is still very wide open, and that there are very distinct views. Right? There are some people who believe that the financial crisis was just the perfect storm. It was brought about by a combination of many small things that maybe in isolation wouldn't have even been that bad, right? But as a combination made a big difference. But it was all these small things that accumulated, and in a way we couldn't really do much against it. It so happened that we had a housing bubble, an underperforming rating agencies, financial sector firms whose incentives were maybe skewed and led to high leverage, right? So these were all small factors where each one by itself, had it just occurred by itself, would not have made a difference, but as a combination, it did. That's one view of the crisis, right? There is a distinctly different view that feels that the financial crisis is an outcome of very fundamental imbalances, macro imbalances in the world, where we have emerging markets like China and India growing and saving at an enormous rate. They have excessive savings rate, but they have no place to put that saving in their respective countries. And therefore, these saving flows needed to find a home. And they've found a home in the US, but looking for safe securities, which therefore then led financial institutions to create near riskless, but sadly not completely riskless securities, right? But you see, this is a very opposing view, because it actually seems to suggest that it's the fundamental flows that created the financial crisis, and then the reverberation that we saw. And then finally, there are some people who feel that it's the government intervention itself that created some of the problems we see today. So the bailout of Bear Stearns, which made in particular unsecured creditors whole, that actually created an expectation for bailout, an expectation for government intervention, which then exacerbated some of the problems we saw. So, this is just to give you a flavor of how big this discussion is that is still raging on. And trust me, we're going to see hundreds and hundreds of PhD theses being written about this as the, as the low end of the output that comes from this. But, kind of my co-panelists here will actually tell us a little bit more how real firms and the real world is thinking about it and is affected by it. So let me start actually by turning the question to Ben and asking, where did we go wrong? In your perspective, what brought up the crisis upon us, and what caused all this mess?
Well, first of all, it's a great honor to be here, and certainly to be in such a beautiful new classroom, and knowing that it's at MIT Sloan, that's exciting.
It's all about managing expectations.
In terms of how you choose to go about describing what went wrong, it's very much going to be driven by sort of the angle that you looked at the crisis. And I'm speaking now as someone who was involved in doing risk management on very substantial amount of assets during the crisis. So I'm looking at it sort of from what went wrong in the markets. And I think the first and perhaps the most profound thing which I took away in terms of what went wrong was that there was a massive confusion in many people's minds between cash and liquidity. And what I mean by that is that if you're in a world where you think assets are tradable, and for the MIT alumni who took finance and then learned about all the derivatives and partial differential equations that are involved in the financial market, that it somehow implies that the value of a security somehow can be turned into cash, and you can construct arbitrages and things of that sort. So that, in a sense, what is the difference between a stock and cash? If you can go to the exchange and turn one into the other in 3 days, they're identical. The problem, of course, is that they're not. And so if you like, one of the almost an axiom of a lot of how people came to think about markets was disproved. And it's very hard to prove a theory, but it's very easy to disprove one. You just have to see when it doesn't work. And trust me, when you run a very large, and we call it liquidity business, the money market business, and when you can't sell commercial paper, that's not something that was ever in, rightly or wrongly, in most people's conceptualization of the world. So that dimension and the dependency that people created on having liquid markets created, a catastrophe. One way that I like to think about it is if you're running a hospital it would not be an adequate excuse that if you lost patients because you had a power failure and your dialysis machines went down, you would rationally be expected to have had backup power or contingencies in place. To not do that would have been highly imprudent. But I think in the financial markets, people became so confident because there had been an increasing trend towards more transparency, more liquidity, more efficiency, that this became, again, almost an axiom in people's thinking. And so the consequences of that were suddenly people discovering that you can't pay your bills because you might have a tremendous amount of value, but you don't have cash. At one point, on a particularly unpleasant day during the crisis, late in the afternoon, I needed a sort of a sugar fix, and I went to the vending machine in our office, and there was a sort of clear panel, and I saw my payday bar, and I went to my wallet, and by coincidence that day, I had actually a lot of cash in my pocket, but I didn't have a single dollar bill. And I looked at the payday bar, I looked at my wallet, and this light bulb went off in my head. I said, now I understand what I'm seeing back on in the markets, because it was the same thing. You had assets, but assets weren't cash, and you need cash to transact. You need cash to pay your bills. You need cash to make good on short-term claims. So I would say that would be, that fundamental confusion would be number one. Another one that came to mind is sort of the fragility of the markets and sort of the illusion of liquidity, which can occur when you have a highly complex product. So, many firms, BlackRock being one, I'm sure folks at UBS, they have a lot of very smart, sophisticated guys, probably a lot of MIT grads with a lot of complicated models, and you'd be surprised that some very, very complex products could trade at very tight bid-ask spreads because you had sort of smart guy A and smart guy B and smart guy C with their fancy models, and they understood these products, and even though they were highly complex, you could make markets in them. But I think what we learned very much the hard way is that when a crisis event occurs, a market which is dependent on a small number of market participants who are highly sophisticated dealing with this complexity, that shock, it runs the risk of taking out those sophisticated players. And then suddenly you have a situation where what might have been a very tight bid-ask spread because people understood the complexity, suddenly the next bid is the guy says, I don't really have any of that stuff, but I'll do it back of the envelope, and my bid is so damn cheap I can't lose money. So we saw this incredible discontinuity suddenly occur in what had been seemingly liquid markets suddenly collapse. There's sort of what's called a limits to arbitrage argument that has been written about, but we saw that happen in practice. And in fact, I remember situations where we had the ability to spot value in the markets, but we had no ability to invest upon it because the particular vehicles that had that expertise were also barely hanging on for dear life because of the breakdown in liquidity. So the fragility of markets is something which I think was part of the confusion, where how can it be very tight bid-ask spread one day and literally no bid the next day because of that complexity. Another thing which came to mind very slowly, and I think Alan Greenspan, when he sort of made his confession, was saying that he thought that the private sector would be able to allocate capital and do credit analysis well, and he was surprised that didn't work. And in my capacity, we had no idea that some of the assets were being held in such concentration on the balance sheets of many of our major counterparties. And we had no idea, not because we weren't paying attention, but the information just wasn't available. So I remember being literally dumbfounded that these massive concentrations existed, and there was no way to know about it. So that was certainly, the lack of transparency was a big issue. I think the final point I'd make you know, we can argue whether it was good or bad, some of the policies that the regulators did, as Antoinette said, but there's no question in my mind that the decision to let Lehman Brothers fail was a catastrophic failure and a tremendous error in judgment, which had profound consequences. You suddenly had an entity which the market completely believed was going to survive, and you came to work on Monday morning and it was gone, and there weren't people answering the phones. And if you're a large counterparty, you could have billions of dollars of transactions and you don't know whether they exist or not. So you're literally blind. And you discovered that collateral was being seized in the UK. And the immediate consequence of that was that if you have a fiduciary obligation to your investors, which most asset managers do, you had to immediately go out and almost deliberately try to bankrupt every other broker-dealer by pulling in your assets. Because having seen that a very large counterparty could be let to fail, you weren't being paid to have a risk of having exposure. So people pulled in their cash balances all over the place, and that created this massive contraction, which, you know, but for the fact that the Treasury intervened, was going to drive the system into complete collapse.
Thank you for this very good description of how the market in the US contracted. And so I would like to ask Jiwon to now, you know, from his perspective, tell us how this looked from Asia while,
yes.
you know, Ben was struggling with his payday.
Very good.
Loan.
Thank you. Thank you. As I suspect most of you know, Asia didn't suffer and isn't suffering nearly as much as the US or in Europe. The region has its own set of problems, which we can discuss a little bit later, but I think the main reasons why the region didn't really suffer as much is really three main reasons. Number one, we went through a financial crisis of our own back in 1997, known as the Asian financial crisis. And in that process, I think banks and corporations became very much aware that leverage was something that they needed to control. And by the time the 2008 credit crisis came, banks and corporations had been deleveraging for a better part of 10 years. You know, so there is actually fairly low levels of debt on the balance sheets of both banks and corporations. And so the starting point was actually a much more sound financial footing for these organizations. Two, for a variety of different reasons, and partly because of the financial crisis in '97, the banks in Asia were in a much healthier position. Just to give you an example, the loan-to-deposit ratio for an average Asian bank going into 2008 was somewhere around 70 to 80%. By comparison, a loan-to-deposit ratio of most Western banks was anywhere between 150 to 200%. So it's just an example that I think it's an indication that the Asian banks were not necessarily eating into its core funding base or living beyond its means. And to some extent, it just meant that Asian banks were not nearly as stretched as some of the Western counterparts. The last point I would make is that the use of some of the complex derivative products that Ben alluded to, especially collateralized debt obligations or other types of mortgage-backed securities, was much more limited in the Asian markets than the counterparts here in the West. So I think some of the discontinuities in the marketplace that Ben described was not as observable in Asia because those products were nowhere near as prevalent. Now, I just want to make sure that I make it very clear to you that the Asian markets didn't avoid some of these problems, not because they were smarter. They just happened to be luckier in the sense that they had gone through a crisis of their own 10 years before, and they had essentially taken measures to address some of those things. And I think it's important to recognize that their starting point was a different one from their counterparts here in the West. Now, I think despite the fact that the core banking system was much more sound, it's important to also recognize that the Asian markets are still suffering from some of the secondary impacts that we experienced throughout the crisis. I think the interesting observation I would make is that once the crisis hit, the markets across the region plummeted, and in fact, in most cases, the emerging markets in Asia actually sold off more aggressively than the US market or the European markets. But within a year, they actually rebounded very quickly, and to a large extent, I would say they're at this point fully recovered, and they're trading at a level that's comparable to pre-crisis levels. And to me, what's really interesting is that it really, for the first time in recent memory, it challenges the old truism that when the US sneezes, Asia used to catch a cold. But for the first time in modern history, I think, the Asian economic growth, to me, is an indication that it's less tied principally to the growth in the US. I think there's enough of an intra-regional trading and activity going on. There's enough of a domestic market developing some of these key markets where the external shocks are not having as much an impact as they used to. And as a result, I think overall the Asian markets and Asian economies are growing. They're on average growing between 7 to 8% this year, compared to their counterparts in the West, who are growing somewhere between 2 to 3%. And we believe that trend will continue for the foreseeable future. Now that said, the story isn't all upside. I think as partly a result of the money pouring in from the quantitative easing in the US, and also large stimulus packages both in the US and in Asia, the threat of asset bubbles and increasingly consumer price inflation is going to be a big challenge. Right. And I think we can certainly talk about that a little bit further. But I think it's not all roses. I mean, it's not all good story. There are some significant challenges brewing in the Asian market, something that the policymakers will have to keep an eye on.
Thank you, absolutely. And it's interesting to see, you're saying the policymakers have to keep an eye on it, but of course we have also seen that on the private market side, financial institutions, banks, very much try to change practices in the aftermath of the crisis, right? I mean, Jiwon was saying, yes, the Asian financial sector had gone through a crisis before, so maybe was a little bit more prepared. The US is in a way catching up now. So I would like to turn the question back to Ben and saying, given all these problems that we just heard, how is the private sector responding? How are firms like yourself, but also, of course, your competitors that you see in the market, what are the responses that you see and how do you assess those?
Well, I mean, one narrow thing I observe is that risk managers get just a little more respect than they used to before, which, if history is a guide, is a short-lived phenomena. In fact, I had worked on a book in 1998 with a colleague of mine, and we were getting pretty far down the road, and of course the long-term capital situation arose. We had to drop our pens and go back, and when we finally published the book in 2000, the comment was that when markets are good, risk managers either write books or learn new hobbies. So I'm looking for a new hobby. But I would narrowly address, I guess, two areas where I think we've seen major changes and perhaps more will be coming. I mean, the irony is that the mortgage market, which was such a source of problems, some of the things which cause those problems have been exacerbated rather than remediated by the crisis, so that the subsidies that are going into the housing market today are much greater than they were before. Today, roughly 90% of all mortgages are securitized by the Fannie Mae, Freddie Mac, the Federal Housing Authority, or Ginnie Mae. So that if there's less, if you like, private market influence on the cost of financing for the U.S. mortgage market. At the same time, the securitization market outside of the government guaranteed is almost gone. There used to be just billions and billions of issuance, what was called private label mortgages, which were the quote jumbo and super jumbo mortgages, and that has gone away. There's almost none of that kind of issuances, so that the mortgage market has been more federalized rather than less federalized, and I think in order to ultimately remediate the process, some of the housing subsidies that have been implicit in the low mortgage rates need to be relieved. Now, this is the reason for this, of course, is that despite the fact that the housing market has come down quite a bit, it is continuing to fall, and policymakers find themselves into this dilemma that the proper medicine for the market is more rationing of credit, but doing that at a time when there is falling housing prices is extremely difficult and politically impossible. So that's a situation where we've had a change, but it's actually gone arguably in the opposite direction of where it ultimately needs to go. I think the policymakers are quite aware of this. It's just that they can't act now. So that's a story to be continued. And one I would ideally have hoped to be able to say that it was moving towards a more of a rationalization. So, for example, in banking, we see capital is going up. The regulations are being tightened. The system is becoming more secure. We don't see that in the mortgage market. I think the second area where there's been more thought and much more debate, and I think is moving more in the right direction, is the debunking of what was called the endowment model. And the endowment model was sort of a theory of how you invest endowments, let's say at a university, where the perceived wisdom was that if liquidity was for chumps, that tradable stocks and bonds were poor investments, and that if you were a long-term investor, you should be investing in things which other people can't invest in, long horizon assets. So universities were buying forests, they were buying windmills, they were buying anything. You may know of other bizarre things, but in other words, this endowment model became very much in vogue, and universities would compete by saying who had the highest total rate of return, over, let's say, a year or 5-year period. And I think Yale was sort of very much in the forefront of saying that their investments did better than everyone else's because they had all this esoteric assets. Now, putting aside the question of how do you know the total rate of return on a forest, there is one thing you do know about a forest. I mean, if I had trouble using a $20 bill to pay for my payday, I think they would have even more difficulty trying to pay Antoinette with a tree.
I would accept the monkey, maybe.
And that, in fact, is what happened. And some of the universities found themselves in a massive cash shortfall. And in fact, some universities went so far as to being levered. I believe Harvard levered their endowment. So, and because they didn't believe in holding liquid assets, and they certainly didn't believe in owning any non-government bonds, there was no cash. And you discover that while a bond may not be that tradable, it does actually do something which is very interesting. It pays coupons and it pays principal. So a laddered portfolio of bonds will actually generate cash flow. And again, going back to the point I made before, about liquidity being underestimated, this was very much the case in the endowment world, and it was basically investing done with no appreciation for the fact that there was a liability that had to be funded, Exhibit A, and Exhibit B, this beautiful, the building and the maintenance of a university, that there is a need for cash flow. So I think endowments have stepped back from that, to the extent that they can. And some of them are so illiquid that even now they're struggling. Many universities wound up issuing bonds. They wound up laying off faculties. They stopped construction projects. So all sorts of sort of brick and mortar problems came because they didn't have the cash required to do what they needed to do. And that's something which I think is changing, although one sort of discouraging note, I was talking to a head of an endowment not that long ago, and he was, and we talked about this idea of, shouldn't you actually be explicitly funding your liabilities, and you can have your sort of speculative portfolio, but you need to be able to fund your liabilities explicitly. And the comment that I got back was that, yes, it's right in theory, but there's so much pressure to sort of post those high numbers, and if you have a significant amount of your assets funding liabilities, you will look less well in that competition. And the big fear was, therefore, donors would say, well, I don't want to donate to University A because they don't earn as much on their assets. I want to invest more money in University B, where they seem to be making more money on my money. So there's been some reform on that area, but perhaps less than there needs to be. I think one last point I would make, with respect to something that I've run across sort of from an Asian perspective, we find much less, there's much less credibility, if you like, in some of the models and techniques which have been used in the past. And we've had a number of clients come to us and say, look, we don't want you to manage this portfolio to a defined level of ex-ante risk. We want you to manage the portfolio to this level of ex-post risk. And you try to explain that that's kind of hard to do because our ability to forecast the future is not perfect, but there's much less patience for that argument, so it puts certainly the risk managers in a conundrum.
It's like my students like to say, the markets are magic, and so we need to be all psychics rather than finance professors, but yes. So it's actually interesting, what you're saying. I think MIT is a good example of, you said Exhibit A, but it's true that we have assets that are very liquid, like tenured professors, right, in these beautiful buildings, but we have margins that are actually adjustable. And I think one of the big mistakes that you see, especially in large endowments, is that there were a lot of long-run commitments made against a future return stream that obviously wasn't certain at all, and also was not matched in its maturity to the long-run commitments that these universities made, right? Which is, in a way, an example of the broader issue that you brought up before, how even financial institutions were caught with very liquid assets, believing that they could be rolled over when needed, and that actually didn't happen in the crisis, right? So it would be
Sure.
very nice to see from your perspective, Stuart,
Yes.
how did this play out?
Sure. As many of you are already aware, interest rates in Asian economies are actually in some way or form tied to U.S. monetary policy. In some countries like Hong Kong, it's a hard dollar peg, so the Hong Kong Monetary Authority has really no interest rate policy of its own. It simply follows what the U.S. government does. In other countries, I think there is a basket or weighted, which kind of broadly mimics the change in the U.S. monetary policy. So to a large extent, the biggest issue in Asia today is inflation, because the economic fundamentals of the two regions could not be more different. Here in the U.S., you have a lower growth economic environment dealing with the aftermath of the credit crisis that pared household balance sheets and will take perhaps a few more years to recover. In Asia, as I said, I think there's really high growth, 7 to 8% growth. The companies generally have perhaps slightly lower debt, and I would say on average probably a little bit healthier balance sheets. So I think you have a very divergent economic condition, and yet the interest rate policies are pretty much similar. So if you take a look at it from a very macro view, for U.S., which needs to stabilize housing prices, keep money flowing, and prevent economy from collapse, low interest rates works. But for Asia, which needs to rein in spending, make sure they control inflation, and to prevent asset bubbles, it doesn't. And yet the policymakers are still stuck to their old way of thinking, ensuring that they maintain certain degree of export competitiveness. And I think is a excess and an instability that's growing in the marketplace. Just to give you an example, in China, you have wage inflation, you have food inflation, you have commodity inflation, right? So the official data for inflation figures in China might be 4 to 5%, but food inflation is somewhere in 16, 17%, right? So for the average citizens, their day-to-day lives, inflation number is actually much, much higher than the official figures. And that's something that the policymakers have been trying and will have to address in the coming months. And I think that same issue actually translates across all the major economies in Asia. So I would say that's sort of the biggest theme for us.
Right. This export of U.S. inflation abroad.
Precisely.
Right? Which is exactly what you need right now.
That's precisely the case.
And if you think of it from, like, let's say, the perspective of a, kind of leading banker in that region, do you feel that it affects your ability, in private markets, for example, even to rein in, obviously in the US in particular, and also in Europe, we had a lot of outcry about how banks and other financial sector players internally are monitored, and the kind of incentives that are put on, high wages, very high growth in wages. Do you see some of that changing in the aftermath?
Yes,
of
absolutely. Yes, I would say so. What's also interesting to me is, I don't know whether you see it here, but when the quantitative easing is announced, sitting in Asia, you could actually see a wall of money coming across the Pacific Ocean. And it really is, and the economies are small enough where when that wave hits you, you can actually feel it. So we keep an eye on sort of fund flows across various markets, and the first sort of canary in a coal mine that we look at is very small emerging markets going absolutely crazy, and markets like the Philippines were just going through the roof at the end of last year. So I think it really is a significant issue that we have to keep an eye on.
Very interesting. Do you want to comment from? No? Okay. So maybe then thinking about all these systemic changes that we have gone through and that we have seen coming, in the aftermath of this crisis, we've seen a lot of regulatory attempts and a lot of regulatory activities starting in the US, of course, and also these things might have effects more globally, right? Dodd-Frank, Basel III, new capital requirements. Is that something that you are concerned about? How are you thinking about those changes?
Yes. I think from our point of view, this is a global crisis, and therefore, in some ways, you need a global framework to solve the problems. I fully understand that regulators ultimately have to look at their domestic markets and come up with its own domestic regulations. But as a global organization operating in multiple countries and multiple jurisdictions, the most difficult part is when one regulator in one region says you have to do X going in one direction, and a regulator in a different jurisdiction saying you have to do Y. And I think part of the difficulty and the challenge that we have is there is no global regulatory framework to address some of the challenges that we have across various regions. And I think until such time as the Dodd-Frank, the Volcker Rule, the Basel III, the Financial Stability Board issues all kind of line up, this will be a rather, it's a regulatory fog of regulatory uncertainty. You just can't see through everything yet. So I think all the banks are in a much more conservative mode of trying to just rebuild their capital, reduce their risk, and as a result, they're not lending as much, right? So I think that will also have some global implications.
Do you see, there's obviously also more emphasis on macroprudential rules rather than microprudential rules, so
Yes.
trying to think about the systemic implications of an individual bank on the system, right? We've seen one of the big pitfalls through the crisis was that when you increase capital requirements for an individual bank, that might be great if that's the only bank that is in trouble, right? Because they can either raise capital cheaply or shrink their balance sheet as needed.
Yes.
But of course, if all banks in the system are trying to do this at the same time, we get big externalities in the system, asset fire sales, and obviously also, which is maybe even worse, the constriction of lending in the economy as such.
Yes.
Is that something that you've seen in action in Asia too? Is this less so?
No, I think that's very true. I guess closer to home, looking at our own organization, UBS, we are a very large bank in the context of Switzerland. The balance sheet of UBS is, Walter, what would you say, 3 times? It's 3.8 times the GDP of Switzerland. So as a nation, they absolutely cannot have or afford to have either a UBS or a Credit Suisse go bankrupt. And so as a result, they're putting on regulations on top of Basel III, and essentially asking these 2 organizations, systemically relevant banks, to build up additional capital on top of what Basel III says. So basically, I think there's a possibility, as it currently reads, that our core Tier 1 ratio has to go up to something like 21%. Now, if you look at any banks, that's almost an impossible rate to maintain and be profitable, because the return on equities, all of that will go down to single digits. So that's another reason why I say that the current regulatory environment is in many ways unworkable, and that we have to get to a place over time where various regulators sitting in the US and in Europe and in Asia will have to come together and come up with something much more reasonable and commercial.
Yeah. Let's hope that some of this indeed will go forward. How does this look from your perspective?
Well, certainly, if you have 21% capital, you would be a very excellent counterparty to work with.
There you go.
So the interests of the borrowers and the equity don't always align, and to some extent, without making any specific judgment on Switzerland per se, that is a tension that underlies what this is all about, because it is in the interest of the system to have more capital than might be the case of any individual institution by itself. In terms of what we see, so in fact, I would agree with pretty much everything she once said about where things are evolving in terms of balance sheet shrinkage, capital raising. There are also some changes in terms of the compensation structures of companies to try to make employees be more aligned with the equity and then ultimately therefore the system. There are more investments in risk management and things of that sort. So all those right and proper things seem to be happening. It is very hard to do that when you don't know the rules of the game and they're changing. I like your term, sort of the regulatory fog. That's certainly what it feels like when you don't know what to do. Whether an institution is going to be deemed to be systemically important financial institution or not. The SIFI designation is being bounced around, and who's going to get that designation and its implications still remain to be determined. You also see institutions being a little more conservative, the more cash on the balance sheet. All good things. The concern that I have is that I do wonder whether or not there's going to be sufficient sort of institutional memory which keeps the focus on these needed reforms. I mean, one of the challenges is that many all these financial institutions, they need to be able to play in the sandbox but the structure doesn't necessarily give any one of them an interest in the preservation of that sandbox, and we need a referee to do that. And while no one likes to admit that, it has to be from economic principles the case. Going to more, at a low level, we do see, certain kind of new financial products that are being developed, which are trying to be responsive to the crisis. So there are demand for what they call tail risk hedging products where people are looking for things that will respond in the extreme events. People are conscious of the, year after year after year, people will say, well, the world is not normally distributed, but then they use normally distributed models, and it's not based on ignorance, but people really seem to be getting that. So there's concern about that. People are certainly learning about liquidity, not just in terms of having cash, but one of the great paradoxes of what occurred during the financial crisis, and maybe Antoinette, you know if work has been done on this, but as an observer, precisely at the time when liquidity was collapsing in over-the-counter markets, volumes on stock exchanges were actually going through the roof. Right. So there's sort of a paradox of liquidity. So we are seeing more and more ETF type products, which are letting people efficiently put on sort of more and more different types of beta, but with exchange traded liquidity. There are efforts to create CCP, central counterparties, so that you can have disentangling of some of the interconnections by having a transaction be with a counterparty, the central counterparty, as opposed to bank A, B, C, or D, so that so long as there's sufficient collateral, you're not necessarily going to be in harm's way if any single institution fails. Whether that survives a stress test, is yet to be determined. Some people have argued that what it's really doing is just going to move the risk from one place to another. I'm optimistic about it personally, but until we see it, we don't know. It's just a conjecture. One thing which is maybe a little disconcerting. One of the consequences of the crisis has been this incredibly steep yield curve, with near zero rates of return for yields on short securities, cash type instruments. And there's been a massive transfer of wealth in effect from the savers to the financial institutions who can arbitrage based upon that. But there is starting to be products created which are sort of attempting to provide yield, through sort of I'd say almost obfuscating risk. But people are, particularly retirees, are very vulnerable to the need that they have to have income to live on, right. And people are trying to create more and more products that purport to do that, but since it doesn't exist in the system, it can only be done by finding another form of risk and substituting it. So that is a little disconcerting.
Thank you. I think you're raising a very interesting point about these competitive externalities, right? Where if there is no referee, if there is not good regulation, even the banks and the institutions that want to play by the rules, right, will not be able to just invent their own rules when others can undermine it, right? And we've seen this in retail financial markets, and obviously also on a much more global scale. Now, that all seems to raise a very depressing view of the future, what we've said so far, right? Maybe I would like to see whether I can steer us in a slightly happier note. Let me, before I also want to open the debate up for questions from the audience, but I wanted to ask our guests here whether you think that given all these experiences, will we see lesser financial integration and maybe actually impediments, greater and greater impediments in financial markets going forward? Or how do you see the future of global financial markets? And maybe Chiwan, if you want to comment on this one.
I think the overall trend of global financial market integration is going to continue. The fact is, at the end of the day, that there is a lot more global trade taking place. And the financing bit is just the enabler of all that activity to take place. So while we might have some short-term dislocations, and as I said, there are some regulatory challenges across various jurisdictions, so you may have some time, you may have to go through a process whereby you're harmonizing regulations and so on. But in the long run, I think the integration will continue and will become even stronger over time.
Thank you. Would you agree with this? Or?
You know, I'm glad to be able to say at least something optimistic. I agree with that as well. I think it is inevitable that there's going to be continued improvements. There's certainly plenty of room for integration to improve. It may not be the case that that integration takes the form that's identical to, let's say, trading among the European Union or among the U.S. and the UK. But certainly it's going to move dramatically in that direction. It does seem that there are some structural elements to how it's being done now, which either are arising from, in one view, a sort of experiment and try to make the changes be orderly by not sort of opening up the floodgates. And there's a lot of reasons why that would be a smart way to approach it. You don't want to create the kind of in and outs of capital which created some of the disruptions back during the Asian crisis. Whether or not you end up in a place where there's sort of a complete harmonization, I think that would be very much contingent on the establishment of a legal and political balance in the region, which would make it be the case that a financial claim would be perceived to be equally valid, in a U.S. court or the court in various Asian countries. And I think that's moving in the right direction, but there's certainly it is not uniform, and that may be what will perhaps the equilibrium may be slightly tilted disproportionately relative to the sourcing of capital, because there's going to be some reluctance on investors to take some of that legal and ultimately the executability of the claims risk.
Right. And of course, it also takes time to build that track record, right? It's not about just on paper it's there, but it has to be tested and proved so that participants actually see that those claims hold, right, as you were saying. Do you want to make a comment on this? Or?
No, I'm fine.
So then why don't we open up the discussion to the audience, and we have mics and microphones, and we can actually maybe while people are coming over take a first question. Let me give you one anecdote I wanted to share with you now actually that I see you sitting here, and I say let's open up the discussion to the audience. About 3 years ago I was in a panel discussion just like this when kind of at the beginning of the crisis, and the late Paul Samuelson, who unfortunately is not here anymore, he was on the panel, and the moderator at the time said, we have as much expertise in the audience as we have on the panel, so we should engage our audience. And Paul Samuelson turned to the panel leader and said, "Speak only for yourself." So I'm only speaking for myself, but we will take questions from the audience. Yes, sir.
Taking off from what Ben said, the question I've always been left with is, it was Keynes, I think, who originally said that markets can stay irrational longer than you can stay liquid. And that was a major fault of the long-term capital crisis. It's a chapter title of the book. It was certainly part of the dot-com bust. Why does the financial world still pretend like their markets are rational, that they will behave rationally, that these kind of the pricing irrationality you talk about, why do they behave as if that's not going to happen or can't happen?
Well, that's quite a question. And I think you need the new generation of MIT people to answer that question. Than those who are steeped in the efficient market paradigm for many years. So I'll pass the buck.
Let me say, I think I very much agree with you that this is a conundrum, right? And I feel that what modern finance and theory and also empirical work is trying to do is to come up with a more cohesive model of how to think about sentiment. And I think, the rational model, at least on the academic side, very much often is the fallback because we don't have a model of irrationality, right? And so it therefore then leads you, and I feel there is a lot of very interesting work now being done on finance and psychology and behavioral economics to really try to move the needle in the direction that you are suggesting, right? But I think from a practical perspective, we might not have as solid a model as we would like, right? Now, some of my colleagues would say, who probably come more from a rational market tradition than I come, they would, however, also point out, and I think that's very important to make that point, is that while we see we see bubbles, we might see individual stocks where you wonder, how much the valuation is off. On average, it is still true, right, that it's very difficult to beat markets, and we don't find that there are many funds that actually have alpha. So if it was really true that there was a predictable irrationality, or this, people often say, oh, there's, this exuberance, as if it was a factor that we could factor in, like, let's say Kaplan factor, you should see people actually be able to trade on it, but they can't, right? And so that, I think, what makes this just so very difficult.
If I may, I'm reminded of a comment made by the late Professor Fisher Black, who was originally one of the founders of Black-Scholes model. He was a professor here at Sloan and then went to work at Goldman Sachs for a while. And I remember running into him and having a discussion when I was in New York, when I was working in New York. And he actually said that markets looked much more efficient in Boston than when he does in New York. Okay, so I think that is an interesting description of how things work. The other thing I would say is, as long as we have fear and greed operating in the financial markets, it's impossible to root out crises. We're always going to have crises. But the real focus has to be on making sure that the future crises don't lead to systemic risk, right? So I think the kind of debates that are taking place amongst Europe and the US and in Asia is really how do we protect and make sure that systemically relevant or too big to fail organizations are ring-fenced. And I think that debate will probably rage on for many more years to come.
Absolutely. There was a question over here. Sir?
Ben, since we're just with friends here, and you were in the middle of this financial meltdown, managing a huge amount of money. What were your emotions during the biggest collapse probably of our lifetime, and given your responsibility, how did you deal with your fears and emotions during that time?
Well, my wife might be a better person to speak to that. It's interesting, and perhaps people evolve to environments that sort of suit them better than others might. I don't get particularly agitated about most of the things that happen. I mean, we try to organize ourselves in a way that we're paying attention, we're identifying the risks that are out there, that we're measuring them properly, that the decision makers are taking them. We like to use the term sort of deliberate, diversified, and scaled, so that we worry about the inadvertent exposures and the disproportionate ones. So most of the time, if you're a large enough institution, you're going to have, the 95% outliers are pretty routine. They happen, like, if there are enough funds, you got them every day, and you have them in both directions. The part of the, so as things were unfolding, initially, it felt like, yes, it was stressful, but we're organized right, we have the information, we have smart people who are doing the right things. There was, one particular time where when I came to realize that the money market funds, were going to collapse. And it wasn't, just a BlackRock thing, it was a systemic thing. And actually, that was the only time in my career when I realized I was getting very stressed out. And I sort of took a walk around the block a couple times just to sort of get my head in the right place. And then, of course, we had our CEOs, call the Treasury and the Fed and let them know what we were seeing and that it was going to happen. And it was for me terrifying because my thought was that, if a money market fails, then you have that, and it wasn't just going to be one. In fact, ironically, I mean, we just wanted, from a BlackRock point of view, we wanted to make sure we weren't the first. But we knew it was inevitable. That type of failure goes beyond the institutions to the retail, and I could sort of envision, panic, literally panic, and people lining up, and what do you line up for a money market fund? It's usually not a physical bank, and I didn't see a scenario. I mean, the day that, I learned Saturday night that Lehman was going to be let fail, and that was very scary because we didn't have a plan B. In other words, we didn't think that could happen, and we didn't think that there was a way to manage that. And then certainly when you have these sort of elaborate systems and tools and infrastructure, so you know your exposures and you make sure that they're properly positioned, and then you suddenly find yourself in a situation where the radar doesn't work. You don't know what exposures you have. You don't know if you have billions of dollars of sort of TBA mortgage trades. They might exist or they might not exist. So if we're managing sort of our interest rate exposure to a 0.02, 0.03 duration, and suddenly you might be missing a year or two, that's pretty scary.
Absolutely. Was this more relaxed looking from
No,
Asia on this?
no,
Probably
not at
right?
all. For us, at a personal level, it was a real surreal experience. I had worked at Merrill Lynch when I got out of Sloan, and then I had worked at Lehman Brothers before I moved on to UBS. And both Merrill Lynch and Lehman Brothers effectively disappeared on the same weekend that Ben is referring to. And so for me, to sit there, sitting in Hong Kong, looking at 10 years of my life with two organizations, and those two organizations effectively disappearing on that same weekend was an extremely painful experience. Yeah. I would also say that this crisis in many ways just gave me a lot of room to think about what was really important. And at the end of the day, I think all the complex models and all of that aside, to me, there is absolutely no substitute for good old-fashioned common sense and good judgment. And I think that you cannot replace no matter what you do. And to me, I think as a financial services organization, I'm just reminded constantly that that is what we have to inculcate and indoctrinate in our leaders. And I think that's something that we should never forget about.
I mean, if I could just interject one more point, because it may be relevant to this particular audience. As someone who was trained at MIT for 8 years, there was something about what was happening and a sense of disbelief, and you're trained to think about the world a certain way, and when you suddenly saw that some of sort of these axioms that you had operated under and almost forgot to think about as not as being things that could not occur, it was very disorienting, because if you like, your compass wasn't working anymore. And that, we talked about a regulatory fog. Well, this was sort of an intellectual fog, and I wound up, sort of started writing notes to myself just to help me sort of sort it through, and ultimately turned it into some papers. because it was sort of my way of trying to keep sanity by trying to understand what was it that I was seeing and why was it so bizarre relative to how I had been trained to think about the world.
Right. I think that's a wonderful, maybe even note to end on, because it is true that one thing that the crisis really showed, even when you look from it as an academic perspective, right, is that our models are fabulously well tuned to give you relative valuation, right? And you were saying up to the, whatever you want, hundreds digits. But our valuation are very difficult in an absolute sense, right? One of my colleagues likes to say, if I put you to bed for a month and ask you, a month from now, without seeing the newspaper, to just value the top 5 firms on the US stock exchange, you would just not be able to do that, right? Because everything is what we usually do is relative. It's not, kind of in absolute terms. And I think there is still a lot of challenge. But I would unfortunately have to end this very interesting discussion now. And I want to thank our panelists for giving us such an in-depth view of the crisis, how it unfolded, and even their personal responses to the stresses and the vagaries of this crisis. Thank you, everybody, for a wonderful discussion.
Thank you.